Hi, everyone. David Toll here, publisher at Private Equity Career News. I'm going to be your host for the program today. We got started a few minutes early. I know some of you have already joined. Let me just reward you with a few tips for how to make the most of the GoToWebinar platform that we use. You can already download a copy of today's slides. There's also a really cool report on business development best practices in private equity. You can download both of those from the handout section of your control panel. Also, on your control panel is a question feature. If you have any questions, concerns, go ahead and avail yourself of that. We have about 3 minutes, and I wanted to take advantage of the time to find out a little bit about our panelists today. I've asked them to reveal a hidden talent so you can get a kind of a feel for what they do in their spare time. I'll just start. My hidden talent is that I can recite the poem The Raven by Edgar Allan Poe, and once did it to my daughter's 4th grade class, and they loved it. So that's me. Isaiah, hidden talent.
Thanks, David. So in a prior life, when I had more hair and a little bit smaller waistline, I was a competitive cyclist for a number of years. So rode in a bike race called Little 500 at Indiana University, and kept bike racing after that, and actually moved over to Europe for a little while, and moved over to Belgium, just outside of Bruges, and was a competitive cyclist over there for a little while, and was on a feeder team for Lance Armstrong's team back in the day, as well as did some races for the U.S. national team. But that was in a prior life. A lot of fun though.
Isaiah, that's a good one. Nadim?
So my current hobbies are guitar and golf. If someone wants to, throw in something else that starts with the letter G, I'll look into it. But in terms of a hidden talent, talking about prior lives, way long time ago, I thought I was going to be in the film industry as a producer, director. I worked in the independent film scene. And the way that I never went to film school or anything like that, the way I learned is at that time I used to rent VHS tapes, eventually CDs, go to the library and get like 10 at a time, whether they're black and white classics or foreign films that I'd heard of. New York City was a great place to do that. So somewhere back in my mind, I have a wealth of knowledge of, I'm like a film buff or film idiot or whatever you want to call that.
Okay, I did not know that about you, Nadim. Michael?
Well, I'm not in the same level as Isaiah, but I used to be a competitive lifter, and I still get my butt in the gym 5 days a week. Get up at 4 a.m., get in the gym at 4:30, and work out for about an hour and a half.
Michael, you're doing much better than I am, because I basically just completely hung mine up until the point of when COVID hit in 2020 and said, I can't sit in the house 24 hours a day. I got to get out and do something for a couple hours. So I dusted off the bike and started riding a little bit again in 2020.
So COVID did have some silver linings.
It did have some silver linings.
And Michelle will wrap up our pre-program with your hidden talent.
Yeah, I don't know about any hidden talents, David. I live out in Colorado. I'm a huge fan of outdoor sports. So I do a lot of skiing, mountain biking. I'm a big runner. I've run 7 or 8 marathons, but I think that's pretty common in this world of finance. I think there's a lot of intense people. So nothing hidden. I'm currently, right after this webinar, going to be taking my 3rd surfing lesson. So that's exciting.
Okay, very cool. All right, so let's get started with the formal program. Good morning, everyone, and welcome to a special Private Equity Career News webinar, What Top Originators Predict for 2023. My name is David Toll. I'm the publisher of the weekly newsletter, Private Equity Career News. I'll be your moderator for the program. I'd like to start out thanking our sponsor, Sutton Place Strategies, SBS by Bain & Company, an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. Few housekeeping announcements before we dive into the program. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you'd like to use anything that they say today in an article. Second, you can download a copy of the slides from your control panel. It's in the handout section. You can also download a copy of the results of a 2021 survey of business development professionals in private equity. Lots of valuable information in there on industry practices. Third, later today, I will send you a recording of the program, so no need to take extensive notes. And finally, many of you asked some really good questions of our panelists already when you registered, and those will form the basis for our roundtable discussion, which is coming up in about 10-15 minutes. Please also feel free to ask questions at any time during the program through the question feature on your control panel. I'll be monitoring those and will ask them on your behalf as we go. So I'm grateful to have 4 expert speakers today to guide you through the topic. Nadim Malik is founder and CEO of New York City-based SBS by Bain & Company. Nadim is going to present statistics describing the somewhat slowing state of the M&A market and also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. We have Michael Butler, Chairman and CEO of Seattle-based investment bank Cascadia Capital, where thanks in part to a recent growth equity investment by Atlas Merchant Capital, Michael is overseeing continued expansion nationwide of the firm. We have Michelle Eidson. She's Principal and Head of Business Development at Crestrock Partners. Crestrock is a Denver-based buyout firm with an appetite for software, IT, business services, industrial, and manufacturing deals. And we have Isaiah Knopf, Managing Director in the Financial Sponsors Group at Canaccord Genuity. It's a Vancouver, Canada-based investment bank and wealth management firm. Isaiah works out of the firm's Nashville, Tennessee office. Okay, with that, I wanted to go in turn to each of our speakers and find out a little bit more about your firm, what you do there. Michael, kick us off.
Yeah, so Cascadia Capital is a middle market investment bank. We have about 100 employees, offices in Seattle, Los Angeles, Minneapolis, Austin, and Nashville. We provide M&A services, buy side, sell side, as well as capital raising, both equity and debt. I would say probably 60-70% of our transactions are in the $100 million to $300 million enterprise value range. We go as high as $750 million and as low as $75 million.
Thank you, Michael. Michelle, tell us a little bit more about Crestrock Partners and your role.
Yeah, sure. Happy to. So Crestrock Partners, based in Denver, Colorado. We're investing out of a $400 million committed equity fund. Like you mentioned earlier, our key sector focus is software and technology, IT and business services, and industrials and manufacturing. I'd say in that order. We were founded in 2019. We have 13 investments to date. I've been with the firm since the beginning, and I've had a 10-year career in private equity business development, prior to which I was an investment banker, and I started my career overseas in government consulting.
Super, thanks, Michelle. Isaiah, tell us more about Canaccord Genuity and your role at the firm.
Sure. Thanks, David. So as David mentioned, we're a global middle market investment bank and wealth management practice. Probably most importantly for this conversation, on the banking side, we have about 300 bankers globally, the bulk of which sit in the U.S. So we have about 160 or so bankers in the U.S. We focus on 4 sectors in the U.S. It's technology, healthcare, consumer, and industrial sustainability. Our average enterprise value is right around $300 million. Last year, we completed 234 transactions, 104 of which were on the advisory side. Interesting statistic, which I think kind of ties into today's conversation. If you look at the last 12 months, or looking at our data on the last 12 months through September, we've actually completed 112 advisory transactions. So it'll be interesting to see what happens in the fourth quarter. So we can comp that year over year. But again, I think it ties into this particular topic. And then for myself, I've been with the firm for 6.5 years now in the financial sponsors group, really building out and institutionalizing those relationships with the Michelles of the world, for example, right? So making sure that we're building a reciprocal relationship with the sponsors community. And then prior to joining Canaccord, I was an M&A investment banker for about 10 years or so. So wore that hat for a number of years as well.
Okay, thank you. Thank you for that introduction. And now let me turn it over to Nadeem Malik of SBS by Bain & Company. Nadeem will introduce himself and also go through a presentation shedding some light on the current state of the M&A market. Nadeem, the floor is yours.
Thanks, David, and thank you everyone for joining us today. Those of us here in the north, hope you're enjoying some beautiful, glorious fall weather. These 2 weeks or 3 weeks, whatever you want to call it, are pretty much the only times I can rub it into those in warmer climates. So I'm not going to miss a chance to do that. At SPS by Bain & Company, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in an efficient manner in this market or any market, using data analytics, technology, and automation. What a difference a year makes. You know, the older I get, time seems to go a lot faster. Some kind of trick, some kind of mean trick. But as I reflect, we do this panel every quarter, and as I reflect a year ago, it's hard to imagine the tone and the environment and how much it's changed. I think the phrase to summarize it, and that everyone, it was the catchphrase, is drinking from a fire hose, right? Remember the impending tax change that never happened? Remember having more deals than you can handle? M&A advisors and service providers turning away business due to capacity constraints? I've never seen anything like that. And now, well, let's find out. I'm really looking forward to hearing the perspective of our panelists who are great at what they do and have been doing it for a while, each of them grappling with many of the same questions as our audience. But before turning things over to them, I wanted to spend 8 to 10 minutes walking through some slides to help frame our conversation, starting with the one you see before you right now. In case you didn't hear, PE activity was up over 50% in 2021 compared to 2020, and was the first year that private equity outpaced corporate buyers as a share of the overall M&A market. So far, looking at the first 3 quarters of this year, PE is still outpacing corporates. I wonder if that's a trend that's here to stay. And it's about 13% below last year's levels. And when you take into consideration that Q3 data is kind of still coming in, it'll be down even less. So it doesn't seem like it's been down that much. But that could be a little misleading. If you go to the next slide and break down the numbers on a quarterly basis, they've been trending downwards since last year, and Q3 is down 24% compared to Q3 last year. But on the other hand, It's slightly above Q3 2019 pre-COVID levels, which was actually a pretty busy year. You know what it is with the data right now? It's sending mixed signals. Just like the stock market and economy, it's the same thing with the private equity and M&A world right now. No one knows which way it's going to go. Employment looks great. Growth isn't bad. But what about inflation? What about high interest rates? Is there a recession? How long will it last? How bad will it be? The variance of responses you get when you talk to people is wider than I ever remember in the PE and M&A ecosystem right now. Moving to the next slide. Here's a look at the most active sectors for private equity for the first 3 quarters of 2020 compared to 2021. Industrials is by far the most active and only down slightly so far this year, followed by business services and technology. The tech sector has taken the biggest hit. We saw, a lot of growth in that sector for the last decade. It's down sharply compared to last year, followed by the healthcare sector, which is also down. Moving on to the next slide. Part of the reason private equity is outpacing corporate activity is due to the increase in add-ons by private equity firms. The trend that we've seen in prior years of the buy and build and roll-up strategies has not just continued, but accelerated so far this year, with PE firms now completing 2.7 add-ons, almost 3 add-ons for every platform they do. I'll add that a lot of our clients, especially the larger funds, are taking much more of a focused effort to understand the deal sourcing landscape in the lower middle market, which is very different and much more fragmented than the upper end of the market. And there's advantages to that lower end of the market because some of the macro and global and economic factors impacting the markets are less prominent there. Moving on to the next slide, and going back to the theme of mixed signals, if closed deal activity is indeed going to continue to taper, it's not really showing up in private equity pipeline stats. This shows the median deal flow that a private equity firm is seeing on a quarterly basis, and Q3 2022 came in pretty high. It's the second highest third quarter since we began tracking the data, and way higher than Q3 numbers in 2020 and prior. But this could be because PE firms are just getting way better at deal sourcing and not necessarily mean that there's going to be more closed deals. Moving on to the next slide, I just wanted to quickly point out our new industry taxonomy formed by our parent company, Bain, based on their decades of work with PE firms. We really think this is a game changer. I've been in the financial information and data collection space for 2 decades now, and SIC codes, generic industry trees, they're so very difficult to use and glean, meaningful insights in an efficient manner. You often have to go deal by deal and is this relevant? Is this not relevant? And reclassify everything if you really wanted to get an accurate perspective. So this taxonomy is about 500 subsectors deep, and using this approach, moving on to the next slide, instead of just talking about high-level trends and analysis and kind of the larger picture, which is also very important, you can now drill down and customize data and the perspective gained in a way you can't from other means, eliminating noise. Let's use the healthcare space as an example. On the left side of the slide, we can start with a very broad screen for all private equity and M&A deals in the last 3 years, and then cut it sequentially, first by sector, in this case healthcare, then by size range, then by private equity deals, and within those, platforms versus add-ons versus minority or growth equity, and get a 360 view of the market. Who are the key intermediaries if you're a private equity firm that you ought to be having relationships with? What's your competition? Or if you're targeting sponsor portfolio companies within a particular vertical, who are the ones that are going to have the most activity in your space? Who are the capital providers? I know the market is changing, and to get this type of perspective and cut it in a very granular way can really make the difference in terms of directing your time more efficiently. Moving on to the next slide, and doubling down on this theme of sector focus and understand the market, one of the things you can then do once you've used the sector taxonomy to cut for your market is to plan your travel for your deal sourcing or networking or business development a little more strategically and identify where to go. In the SPS portal, you can build a heat map that looks like this and say, okay, in these sectors, where are all the private equity portfolio target companies? Or where are all the intermediaries in this case? Not the firm's headquarters, but the specific professionals that are doing deals in my space, and which ones maybe aren't currently thinking of me. So strategically, this becomes a great way to prioritize your travel planning, which, you can't be everywhere. You're not going to be able to go to every city. And then once you've decided to go, you can drill down for the city view and really plan your trip. Who's in the same building, who's nearby, so on and so forth. While we're on this topic of travel, moving on to the next slide, we are in the thick of conference season right now. And we have a conference evaluator tool on the dashboard of the SPS portal. The idea here is you get an attendee list for some of these events. Sometimes it's 1,000+ people attending. It could be hard to figure out who you should really prioritize your time with. You can't see everybody. Well, what you can do with this widget on the SPS portal is upload the attendees from Excel, and a report will be generated within seconds that'll sort rank who's going to be the best use of your time based on your criteria and the attendees' closed deal history. A very useful resource to prioritize your time. Moving on to the next slide, we're in the final stages of releasing our 2022 deal origination benchmark report for clients. What you see here is a summary snapshot of last year's results. The Dober is what we call it, has evolved into an industry standard and is an annual detailed review on the effectiveness of a firm's deal sourcing. For example, are they getting better or worse? Are they top quartile? Do they need to cover more intermediaries? Are they seeing less deal flow than their peers? And of course, how can they better prioritize their time? What are the key takeaways and areas on how they can direct their time more strategically moving forward? We've been generating this report and analysis on behalf of our clients for 10 years now. Every year we enhance and add information and analysis based on our client feedback, and we're very excited for the upcoming report in the weeks ahead. Stay tuned on that. I'm sure we'll have some summary stats to share on our next webinar. And finally, I just wanted to use this opportunity to let everyone know that every Thursday morning we have a newsletter called The Source. Sometimes it's a written piece. Other times it's a video interview. The common theme is you're going to hear strategies, tips, and tactics that are being used by top professionals, market trends and industry experts, and the latest reports and insights. So you can go to the address at the bottom to sign up and make sure you're on the distribution list. With that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A.
Thank you, Nadim. Nadim, we did get a follow-up question for you, and it has to do with the fact that with all the dry powder that private equity firms still have, whereas on the other hand, corporate buyers may be coming under pressure with lower revenues, tightening margins. Do you anticipate that private equity firms might extend their lead even more in the race for M&A transactions?
I wouldn't be surprised at all, David. Like, large corporations and M&A strategies tend to move a little slower and tend to be more conservative in terms of wanting to get back into the market. I think we have some great panelists that will probably be able to shed some light on that, but I would feel that private equity firms, given the dry powder, are probably be able to act more nimbly and quickly than the corporates. And so you might see that might be, that's a very astute observation. I could see how that could cause the private equity lead, quote unquote, to continue to extend.
David,
Okay.
it's, I think we may see more corporate divestitures, right? If anything, which is going to be great for sponsors who focus on that particular avenue, if you will, from a sourcing perspective. I do think the one caveat here or unknown is where will interest rates end up, right? Or where will they top out? And that could be what slows down sponsor platform activity, right? So you'd still see maybe a focus on add-ons or continued focus on add-ons.
And Isaiah or Michael, any early indications that are you getting any calls from corporations, kind of feeling you out on possible divestitures?
The majority of our M&A is we don't do a whole bunch of corporate divestiture M&A activity, so it's a little difficult for me to answer that. I see a little bit more so relative to prior years, but Michael, you may have a better insight on that than I do.
Yeah, we're starting to see corporations look at potential divestitures. They're trying to get an idea of what the receptivity would be if they decided to divest a certain asset. I think it's still in the early stages, but it wouldn't surprise me if it picks up pretty dramatically in the next 6 to 18 months.
Okay, well,
Yeah, likewise, it's anecdotal, but we do focus on carve-outs as well. So we do active outreach to the corporates to ask about any divestiture activity. And while it's not significant, we have seen an uptick of inbounds to us from corporates and from bankers representing corporates that are exploring ways to optimize their portfolios.
Okay, we'll be keeping an eye out for more corporate carve-outs in the coming months. Before we get right into our roundtable discussion, I want to see if I can take advantage of the large audience that we have today and ask a couple of polling questions. Occasionally, I do have technical issues with these, so bear with me. But we're going to try. First question for everybody is, how do you expect your firm's total number of platform deals next year in 2023 to compare with this year? So this will help us get an understanding for the outlook. I am launching the poll. So your choices are down from this year, even with this year, up to 10% higher than this year, and more than 10% higher than this year.
That's a good question, David, and I'm glad the panelists don't have to answer that.
Okay, it looks like more than half of you have voted, so I'm going to close the poll and see if I can share the results. Okay, so looks like not quite half, but certainly the plurality say that next year will be roughly even with this year. And then the next most popular choice, not a big surprise, the choice of about 25% is down from this year. And then, well, about a third of you think at least 10% higher than this year. Okay, so that's platform deals. And I'm going to hide the results, and we'll go to our next poll. Very similar question. This time we'll ask about add-ons next year. So how do you expect your firm's total number of add-on deals in 2023 to compare with this year? And looks like you should see it on your screen. Again, your choices are down from this year, even with this year, up to 10% higher than this year, or more than 10% higher than this year, Again, we're just talking about add-on acquisitions. And going to give you another few seconds. See if we can get to 50% participation. Okay, we're very close to that. So let me share the results. Okay, the results are similar, but there's one big change. But about half of you think that the number of add-ons you'll do next year will be roughly even with this year. Interestingly, the big difference, very few of you think you'll do fewer add-ons next year than you did this year. And then a higher percentage of you think next year will be up for add-ons compared with platform deals. Okay, let me hide the results and let's get into our discussion. And just a friendly reminder, please keep asking questions. That really adds to the discussion. But I'd like to start off with a question that I'd like each panelist to take in turn. And we'll start with Michelle. What is the quantity and quality of deal flow like out there right now, right as we sit? And also building off the results that you just saw, what's the outlook for 2023 at Crestron?
Yeah, I was just looking at the data again this morning, David. I'd say the quantity is lighter, but it's not terribly light. It feels like we're back to 2019 figures versus, as Nadine described it, the tidal waves that occurred in 20 and 21. So it's not as overwhelming as the past 18 months. I think through the first half of this year, we were tracking with last year or above last year, but that really slowed down in a typical summer. And then the fall's been a little bit lighter. The quality is mixed. There are businesses that are still commanding premium multiples because they're clean, they have desirable deal economics, and they're meeting the criteria of the firms that are accustomed to paying competitive prices. And to everybody's point, there's still a lot of capital that needs to be deployed. The other type of deals that we're seeing are situations where the founders are just either ready to take some chips off the table, retire, or otherwise avoid going through a recession without a partner and some financial peace of mind. So they're willing to accept a little bit of degrade in valuation. So those deals are also in market. As for next year, from my conversations, it sounds like if the credit markets reach some stability, Q1 should be pretty active because there have been a number of companies on the sidelines waiting for the stability. Bankers and private equity owners that know that credit markets are tight, LBOs are harder to get done now, so they're waiting for that to smooth out. So I expect Q1 to be pretty active, and then the rest of 2023 to be stable. I do think our perspective is we are heading into a recession. The markets will be down next year, so we anticipate those deals that come to market will be similar to the characteristics we've seen this quarter. And that's fine. I mean, we are not market timers, so we are looking where we can deploy our capital, and we think we'll be able to find opportunities in that in the market.
Michelle, that sounds pretty optimistic for all the doom and gloom talk out there. Isaiah, what's your perspective?
So look, I think Michelle summed it up pretty well. The quantity this year, or for the latter half of this year, at least from where I sit, is still fairly strong. The quality of deals that are out there, I think there's a barbell scenario going on right now. So your A assets are still fetching premium multiples, and then assets that are in market right now that maybe have some complexity to them, right? Supply chain challenges, interest rate sensitivity, inflationary pressures, you name it. those businesses and valuations are being affected a little bit. But what I think that also creates is, you're talking about the outlook for 2023, and Michelle touched on this as well, is there are businesses or mandates that are maybe being put on hold for the time being, right? So they're not going to market right now because they want some of those variables to lessen, if you will. So that does create, knock on wood, a robust first quarter activity for 2023. I think it will be very much a TBD in terms of what happens for the remainder of 2023 post first quarter. The other thing is you look at, GDP numbers this morning, right? 2.6%. So everyone keeps throwing the R word around, but you're seeing a whole bunch of different statistics out there that say one thing versus the other. So there are a lot of unknowns right now in terms of what is going to happen ultimately within 2023.
Say, Isaiah, you mentioned that there's sort of a lot in the pipeline that may be on pause, on hold, waiting for some of the uncertainty fog to dissipate. Is there anything that we should be looking for that will suddenly open the floodgates? Is it interest rates topping out, talk of recession going down? Based on your past experience and economic ups and downs, what should we be looking for?
I mean, the main thing I think that you can look for would be the Fed saying we're going to pause, right? That's the number one thing that I think we can look at. There are other factors out there, such as, but they're out of our control, or they're out of the U.S.'s control. So, China not having a zero COVID policy, for example, we have no control over that. The war going on in Ukraine and Russia, we have limited control over that, right? Those kind of things, if those mitigate, then I think that ultimately leads to just even more robust M&A. But the number one thing I think we can look at right now is just what is the Fed going to do?
Okay, that's very important to know, and I'm glad we do now. Michael, let's turn to you. What's your quantity and quality of deal flow look like on your plate right now, and what's the outlook?
Yeah, the quantity's been very heavy, extremely heavy. The quality's been mixed, and as Michelle and as Isaiah said, in this market, there's a flight to quality. So we're being very careful about what transactions we take on, making sure that going forward, the ones we take on have high quality. What I'm seeing is slower conversion from pipeline to backlog. Normally, when we send out an engagement letter, within 2 weeks that engagement letter is signed. The average time between sending out an engagement letter to signature can now be 4, 5, 6 weeks. And I think what's happening is a lot of our clients are saying, I'm going to go to market in Q1 of next year. It's October, what's the rush? There doesn't seem to be a forcing function, right? What we're trying to say is it's time to get signed up, get prepared to go to market, because I think there'll be a lot of companies going to market. You want to make sure you're ready to go and you're prepared to go. But I think we do lack that forcing function. I do expect the first half of next year to be pretty robust. I think there'll be a lot of deals coming to market during that first half. What we're trying to do to convince our potential clients to sign the engagement letters is showing them comp transactions at high multiples. I think there's a little bit of a fear from our clients that, all right, I go to market and I want 10 times and I get 8 times. There's that latent fear that we're trying to address.
So some fear of being punished by just going out a couple months earlier before.
Yeah, they read the headlines, they read the press, right? And I think you really need to spend time with them and convince them. And the other thing I'm noticing is companies that we have long-standing relationships with that are getting ready to go to market. We have a strong relationship and trust built up. They're tending to listen to us and believe us and move forward. Companies that we don't have that that long existing relationship are definitely more reticent to take our advice. They're certainly fear of the headlines that they read every day in the press.
Okay, thank you, Michael. And let's move to the next question, which is related, but I'm really, really interested in hearing kind of what subsectors are heating up among sponsors as buyers, and what may be cooling down. And our two investment banker panelists are in a great position to elucidate us on that. Isaiah, why don't you start?
David, I would say subsectors that are heating up would be anything that's taking costs out of the system, right? So supply chain issues, right? How do we take costs out of that? How do we better optimize our working capital, our inventory? Things along those lines. E-commerce, right? So an omni-channel strategy, something that has more of a digital footprint, right? Versus just brick and mortar. We see more and more of that at play. The other piece is, given some of the capital that has been deployed by the government, you think about EV infrastructure, right? So how do you play that market? Because there's a lot of capital that's flowing in there. Even the CHIPS Act, we've had some conversations internally there where semiconductors have been out of favor for years. There's an abundance of capital that's coming in via the CHIPS Act. So is there a way to play that? In terms of subsectors that are maybe cooling down, I would say something that is consumer discretionary focused, for example, right? So I don't think that's necessarily, I think there's just a lot of unknowns right now, right? In terms of what's going to happen for 2023. So I don't think those businesses are necessarily underperforming per se, but I think the buyer universe may be a little bit smaller or less apt to invest in that universe or that subsector until some of these variables that we talked about have been mitigated, right? So those very well could be attractive assets next year, but that also kind of ties back into what Michael and Michelle were talking about earlier in terms of maybe deals being delayed for the time being, right, until first quarter, for example, or the first half of next year. Those consumer discretionary oriented businesses, for example. You don't necessarily want to launch businesses into significant headwinds or perceived headwinds is probably the better way to describe it.
Okay, that's good insight. Michael, what do you have to add on the question of sectors heating up, cooling down with sponsors right now?
Yeah. Our biggest practice this year will be our agricultural practice. And I think if you look historically, ag is a good hedge against inflation. So from growers to packers to shippers, we're seeing robust activity in the ag sector. We're also seeing good activity in some subsectors of food. Food ingredients is a good sector. Food contract manufacturing is another sector we see good activity in. And finally, industrial services. HVAC companies, mechanical contractors, kind of bread and butter businesses, right? They have good track records and a history of generating good margins are seeing a lot of demand from sponsors.
David, I would also say, businesses that are recession resistant, right? In case we do dip into a recession. And Michael brought up a really good point here, and it made me think of this. Basically, businesses that are kind of re-onshoring, right? Any way that you can play that, in ag is a good example of that. You think about outsourced food, for example. If you can basically bring that back in house, you're in a much better position, relative to 2 years ago, whatever it may be.
Okay, and we did just get a question from the audience, which I'm going to direct to Nadim, and that is, how much weight do you give to the political environment with a potential large political shift coming in 2023? Does that impact your investment philosophy? Or how does it impact sellers' timing? Nadeem, I don't know if you're a political animal or not, but what's your thinking?
Well, I did research this recently because I'm trying to figure out stock markets and what the impact of midterm elections, and so I can tell you based on my research and in terms of the public markets, they say that October tends to be down going into midterm elections, and then I discovered there's some trends after a midterm election, whatever the outcome, they tend to go back up. So that's the public markets. I really, over the last couple of decades I've been in this industry, I don't think like midterm elections and that type of politics affects private equity and M&A. I haven't seen it. Maybe in a very isolated incident because they know that some policy is going to change or may have a likelihood of change, and then certain subsectors may be impacted. I'm not sure if the change that looks like it's going to occur in the midterms, and if there's some pundits that might be able to say, well, these subsectors are going to be impacted by that. But in terms of like the macro trends in general, like the stock market performance in this market, I haven't really seen anything in the private equity and M&A world that, for whatever reason, I feel like it's been pretty insulated from that. I don't know if others have a different view or perspective.
I concur. It doesn't really come up in our conversations what's going on politically and how that impacts where we're focusing our investment opportunities or investment focus.
It's a tertiary topic, if that. Right now, there isn't a big tax bill that's out there, right? There's no big catalyst for the community to have a conversation about what's going to happen, if the House and Senate switch to the Republican Party. It just haven't heard a lot about that. Honestly, there are probably too many other variables going on too that has everyone's attention relative to what's going on in a midterm election.
Okay, doesn't sound like the elections will have a big impact on the M&A market, but we'll see. And Michelle, I'd like to stay with you, continuing on our industry theme. What are, in your view, good industries or sectors kind of to jump into right now? What are your main themes that you're pursuing by virtue of where we are in the economic cycle?
Yeah, I mean, I'd say that we typically focus on businesses that have more predictable revenue streams, derived from sticky products or services that will hold it better in a downturn. So software and technology, which is the primary focus of our fund, those companies offer that predictability in terms of revenue and profit. And, those that will always be in high demand, like CRM products or products that help with workflow management, or things that once they're in your organization, they're really tough to rip out. So that's where we tend to focus, and that's really, it doesn't really have an impact based on what economic cycle we're in. Businesses that we avoid, it's more about business models that we avoid, and those that are right now burning cash and having a hard time raising capital, those that are early stage and don't really have market acceptance, I think those companies, in that VC realm are going to have a difficult time right now. Also, I think businesses that rely on the traditional LBO model to get done are a little bit harder to do now because credit is more expensive. On the flip side, if you don't rely on debt to get your deals done, it's a really good time to be focusing on those companies. And I'd say the last thing that we try to avoid, the last attribute we try to avoid, are companies that did really well and got a short-term pop from COVID that aren't likely to hold up as well now as time has passed to reveal what was pandemic-generated growth versus sustainable growth. And that's a little bit trickier. I mean, every business we look at has a really interesting inflection through 20 and 21. So discerning that has been a challenge. But, like I said, we're not market timers. We tend to focus on, software IT services that are, managed service providers, complex data service providers that are critical and necessary and tough to about. So I'd say that's where we're focused. On the industrial side, it's businesses that are driven by, regulatory need, or by virtue of high cost of failure, maintenance and inspection services. I think Michael mentioned HVAC. Those are sectors that we tend to focus on when we look at the industrials, which is a small portion of where we're spending our time.
Michelle, are there changes in the complexion of the competitors that you're going up against in going for target companies?
Well, I'd say I don't have a full view into who I'm competing against in these processes, so that might be better for Isaiah and Michael. But I suspect that my competitors that do use a lot of leverage are not. I feel like we're in a good position where we're well advantaged compared to them. I also think because we have strong, we focus on companies that want more than just our capital. We have a real operational bent to our strategy. We think we'll see more opportunities in this market for companies that need an operational and strategic partner in addition to just capital, and we show nicely against those players as well.
Okay, Michelle, we did get a follow-up question for you, which is, especially in technology and software where you focus, any sign of cooling off in valuations?
It's bifurcated, like Isaiah said earlier. There are a number of companies in market now that I would call A-plus assets. They're Rule of 40 growing at 60%, and they're profitable. And those companies are going to continue to command mid to high single digit, maybe even double digit forward ARR multiples. That's not where most of the market is right now. I think there's been some cooling off for companies that have to come to market now because they need capital, they need a partner to sustain their growth rates, and so there's been a little bit more of a narrowing of the bid-ask spread on the tech side, just based on that. But it really is bifurcated. It's the A-plus assets and then everybody else. So overall, there has been a narrowing. There's been a little bit of softening. And I think if you're in the fintech space or the healthcare IT space and you're coming to market now, you're fully aware that the public markets have brought down valuations, and you're in market now with that full understanding. So you're expecting, a different market environment in 2021.
Okay, we just got a two-part question. Both parts really good. The first one seems tailor-made for Michael, and the second one maybe back to Michelle. The first part is, speaking of private equity macro trends, what are we seeing in terms of geographic private equity hotspots? How are those changing? Michael, you're in the midst of a nationwide expansion, so what's the answer?
Yeah, we definitely see it changing, a much more distributed model. I'm actually relocating from Seattle to Austin, and I'm just stunned at the number of private equity funds located in Austin, in Nashville, in Raleigh-Durham, in Miami. I definitely think that there's a more distributed environment. We still have hubs in San Francisco, Chicago, New York, and also Boston, but it's changing. Denver, Salt Lake City, definitely becoming more democratic, I guess, for lack of a better term.
Okay, Michael, and now I realize on further thought, the second part is also good for you. So let me give that one to you first, then we'll go to Michelle. But is private equity more willing to invest in newer technologies these days, more like a venture capitalist? So we're talking about things like artificial intelligence, batteries, blockchain.
Yeah, up until about 6 months ago, and that hit a brick wall at the 3,000 miles an hour. Yeah, I think less so today than 6 or 9 or 12 months ago.
Okay, but I think you have a new group dedicated to robotics and some of the
yeah, we do.
Yeah, we
do. And it's interesting, David. We had seen pretty good activity from the growth equity funds and some of the PE funds. They have pulled back, and now the corporates are becoming more involved in that sector, which is kind of an interesting rotation.
was interesting. And Michelle, how about you, from your perspective, as the firm's appetite in software and technology kind of embrace some of these newer technologies like artificial intelligence?
Yeah, I mean, we have a platform that implements AI and ML to create its product. It's a company called Unbound. It's in the marketing automation space. And I could argue that across a lot of our platforms for implementing it. We are not specifically investing in AI and ML companies because we don't know. I don't think we're smart enough to know which ones are real and which technologies are going to actually be the ones adopted. So while our companies implement AI and ML and they develop some of those algorithms on their own, we don't focus on those types of businesses. If they even exist. I'd say we don't take product risk at the end of the day. I mean, we're focusing on companies that are adopted by, end markets that are being used today, have broad customer bases, have steady revenue streams, and as they develop their product development roadmap, they are more and more implementing AI and ML, but we don't invest in those in and of themselves. And I don't know if I'm making sense, if that's articulate enough, but we don't invest in those technologies specifically.
Okay, fair enough. We have a question from the audience, which is close to one that I was planning to ask anyway to Isaiah, and that is, what impact are we seeing on the market from the increased cost of capital from lenders, higher interest rates? What's going on?
I would say, and this ties back to Nadim's one of his slides, which is there's an increased focus on add-ons, right? Those are much easier to digest, smaller deals, you can get them financed, versus a platform acquisition, obviously a lot pricier these days. Leverage has come down, right? So that may in turn affect valuation potentially. But again, if it's an A asset, there's a lot of capital that's out there. And we can talk about this a little bit later on, but there are sponsors out there that are potentially willing to pay that premium multiple still and just equitize it more effectively to deploy capital because they have a thesis around a particular asset that they've probably been tracking for a number of years now.
David, I would just add to that, if you don't mind.
Sure.
Yeah, I think this is the elephant in the room. Like, we'd be remiss if we didn't spend at least a few minutes talking about this. Like, the Fed increasing rates, the impact of that is, in many different ways. And in certain ways we can understand maybe more universally. For example, if you have an adjustable rate mortgage on your home, and fewer and fewer people are doing that based on the lessons learned from the financial crisis. But if you have, if you refinance and got an adjustable rate mortgage, when that adjusts in the months and years ahead, like, you're going to get a big shock, in your next mortgage bill. People can understand that, and it's going to take time for that to play out with the increases in the private equity market. There's two sides of it. The cost of capital to do a deal is going up. The private equity firms have certain models. They have certain return thresholds that they expect to achieve on behalf of their investors. For many, leverage is an important part of that. And suddenly the cost of capital to do a deal done is going up because lenders aren't as comfortable, in the current environment, and cost of capital is going up overall. And, potential income because of some of these actions could be going down. So it becomes a real, it could potentially be a scenario where private equity deals have a hard time closing it's a double whammy. Their cost of capital is going up, but the free cash flow of their portfolio companies and prospective companies may or may not be impacted. So these are the things, and this is the type of thing, like, it's really becomes hard to predict. When is deal flow going to go up? How is it going to react? But this is in our world. This is the Fed increasing rates, quote unquote, having its desired effect to slow down the economy and push down inflation, which is so important. These are the impacts that the private equity world is going to deal with, and I think we're just starting to see it now. I don't want to. I'll turn it over to any of the other panelists that want to comment on that.
Well, and substantially, right? The Fed has increased rates substantially in a very short time frame. We don't know what the fallout of that is going to be, and that's why I think the number one thing is, what is the Fed going to do going forward, right? So if there's just less variables there, at least buyers can predict what's going to happen from a free cash flow perspective, right, going forward. I will say that the sponsors community, for the most part, over the last 5-10 years or so, has not put as much leverage on the business that they could, right? So maybe they're getting a 6x read, but they're putting 4.5 turns on there because they want to be able to, finance an add-on, something along those lines. If there's a rainy day, right, they're not going to bust a covenant. So that helps a little bit, right? So maybe they're, instead of 6 turns, they're getting 5 turns now, and they're still putting 4 and 4.5 on there, whatever it may be. So that helps when they're going after those A assets, but it is definitely something that buyers are acutely aware of because it can turn quickly on them to the negative.
Okay, good insight there. And with about 15 minutes left in the program, I want to make a final call for questions from the audience. Probably relied on questions from you guys for about half of our discussion. They've all been good. So please enter your questions now if you have them. And we have a really thoughtful one that's been posted, and that is, what is something people are not paying enough attention to within the M&A market that might be a catalyst for deals down the line? So give me a moment to think about that one. Michael looks like he's thinking. Just raise your hand if you want to jump in. We could come back to it too.
So look,
Go ahead.
I touched on this earlier, right? You think about the CHIPS Act. I mean, this is a big national security issue, right? Having chips come back onshore. That sector in semiconductors has been, for the most part, out of favor for years. People have gotten burned on that. So that is a potential, I think, avenue that can be explored that hasn't necessarily been explored over the last 5-10 years or so. I do think there's a lot of unknowns. You got to figure out how the CHIP Act is going to work, right? You have to have outside capital come in. But that is a potential M&A subsector, if you will, that may have some tailwinds behind it. And it's just a question of how and when do you play it.
Okay, good one. Michael or Michelle, either of you want to jump in on that one?
Yeah, I think the substitution of capital for labor, right? There are labor shortages, and they are going to continue, and you're going to have automation replace labor, and I think how that transitions, the economics around that are going to be extremely important. The use of AI to replace white-collar jobs, the use of robotics to replace blue-collar jobs. I think that's going to be a really, really big issue over the next 3 to 5 years.
And maybe just piggybacking on
right.
that. Oh, sorry, Isaiah. Go ahead.
Hey, go ahead.
I was just going to say maybe piggybacking on that. I mean, I think with labor shortages, with some of the more impactful results of COVID, there's going to be a lot more focus on digitization, on workflow optimization, on efficiencies that are created through software and that are created through outsourced services. So I think that's an area that's going to continue to persist going forward and be good M&A opportunities. And there's a lot of small players out there that are taking advantage of that.
So you look at Nadim's, one of his slides, he's, showing the tech sector was, significant drop off, right? But to Michael's point, you're going to have AI, you're going to have things that help solve the cost equation here over time. Now, it takes a lot of time, it takes a lot of capital and what have you, but you think about like Amazon with their picking and packing. So they're trying to take labor continually out of the equation. That theme is going to continue, regardless of the slowdown in the sector overall, M&A sector overall, regardless of the slowdown in technology. There's enough capital out there that's going to try and find ways to be deployed and to take costs out of the equation.
Agreed.
Okay, next question that just came in is for Nadim. What are sponsors doing to leverage artificial intelligence, data analytics, to scout for new businesses? I'll leave it at that.
I think like the world is going in the direction of AI and predictive analytics, but depending on the sector, the economic impact, the impetus behind it, some are slower than others. And nothing against private equity and the M&A and the financial services, it tends to move a little bit slower than certain other sectors and verticals. So, and if I knew exactly how it was going to impact it, that would make me, it'd be a great bet, but I will say, I have talked to firms, we focus on the deal sourcing side of business, not on the modeling or deal execution and what AI benefits might be there. But on the deal sourcing side, I can see a world where more automation, more alerting, more recognition of patterns, and how that can give you an early lead, whether it's for proprietary deal sourcing, whether it's for creating efficiencies, being able to predict, using lots more data processed in a lot more intelligent fashion, and then projecting forward, what markets to visit more proactively. Where is there, and then when you talk about performance improvement, it's only on the margins, right? You only need a couple of percentages of better knowledge or better data or information or AI when your competition doesn't have it to translate into millions of dollars of returns for your clients. So, we do have certain clients that are experimenting on the deal sourcing side with some of these AI predictive analytics. No one has a home run, and maybe some of them do, but I don't think they would tell me if they did. So.
Yeah, we're using AI at the top of our funnel. And we're experimenting with AI in our healthcare group specifically at the top of the funnel. And I would say it's 2 steps forward, 1 step backward. It's marginally better, but it's not probably where it needs to be meaningfully better from what we're seeing.
And Nadim, a second part to that question is, what is the biggest pain point you're seeing with sponsored tech stacks today?
I would say that the biggest pain point is, when I started SPS 12, 13 years ago, you might not believe me, I was about 1 in 3 emails to private equity folks would get a response to meet, to have a call, to learn more about a product or solution that was very nascent, very early in my mind, and we're trying to figure out. But today, 15 years later, let's call it, everyone knows that what the impact of private equity has. You can see they're doing more deals than corporates. There's a massive shift, and whether it's through their portfolio companies or targeting the private equity firms themselves, everyone is. I guess you can ask Michelle, like she probably gets 100, no exaggeration, unsolicited emails for a technology product or solution, if not daily, definitely weekly, that could help her source more effectively. So the biggest challenge for private equity firms is to figure that out. Like, what do I really need? And it's a big challenge for us. Thankfully, we've been around. We have we've worked with hundreds of firms over the years. But I tell you, we're not getting a 1 to 3 response rate. It's more like 2 to 100, 1 out of 100 or 200 emails that people respond and get a meeting. Because how do you differentiate yourself selling into that space? And then as a buyer, how do you really figure out what you need? Do you have a process in place? Do you have a team? Do you hire a consultant? So this is, I think, the biggest challenge from a private equity standpoint. But maybe Michelle can comment more on it.
Yeah, I'll definitely weigh in. I agree with you 100%. I mean, I was going to say my biggest pain point from a tech perspective is email. I mean, the inbound inflow is it's gotten more voluminous. Is that a word? It's gotten higher volume. But I agree also there are many more tools that are being pitched to private equity. More so, I was an early adopter of SPS at my prior firm, actually, when it was spreadsheets, Nadine. So something about your pitch appealed to me, and I'd say it's the same thing now. I answer maybe 1 in 10 of those emails because something sounds compelling enough to take a call with the salesperson and understand more about the technology. But at the end of the day, it's really hard to get through and differentiate. You kind of have to pick and try. There's certainly no silver bullet in deal sourcing, and there really never has been. And I think that's what keeps our careers really challenging and really separates, the good ones from the winners, I guess. And it really is a constant iteration, an iterative process to come up with the right strategy for your firm.
Okay, we have a few minutes left, and I want to go through a couple final questions. First one is for Michelle, so we'll stay with you. And that is what's working for you these days when it comes to getting and staying on the radar of deal intermediaries? What's maybe not working so well anymore? And how has COVID changed the landscape for you?
Yeah, no, that's a great question. I'd say prior to COVID, the best way to get on the radar was to visit investment bankers in their home offices, sit down with them, have a meaningful discussion, come prepared. Since COVID, we are able to leverage Zoom more, and I think that's been helpful. I also think there's a common understanding that you don't have to be flying all over the country to stay current with your relationships. On the other hand, I think what is getting tiring is just the check-in call. The check-in call with no purpose. So trying to have a purpose for your calls, or trying to come prepared with a topic of discussion, trying to come prepared to talk about your portfolio companies or what you're seeing in the market. I think that's important. I've done virtual coffees where I'll send a Starbucks coffee card to a banker and, for coffee. So just trying to differentiate that way. I think that the regular check-in calls are tough because that's what everyone became accustomed to during COVID, and it's really hard to manage your schedule that way. So differentiating is key. I don't know if Isaiah and Michael will agree. This is my perspective, just based on feedback I get when I reach out.
Let's turn to Isaiah and Michael. And a related question, but not quite the same. We're seeing a lot more, as I understand it, sort of narrow processes, limited auctions, and private equity firms want to know what's the best strategies for differentiating themselves in those and obviously coming out on top. Isaiah, what's your best advice?
I'm taking notes, Isaiah.
You're taking notes? The best advice there is if you can meet with the company and management ahead of a process, right? So our conference, for example, we had 150 private companies there. We had 600 sponsors. We ended up with 1,900 one-on-one meetings. That allows the sponsors to do some work in advance of a process, right? And so what happens there is they can potentially preempt if they've done a bunch of work ahead of it, or at least, they have more of a feel, if you will, and actually more data as it relates to that particular business. So what can they do with that business post acquisition? Do they understand the TAM? Do they understand the add-on strategy that can be deployed there? Right, that gives those particular sponsors who have a theme or thesis a leg up relative to their peers. I mean, there's trillions of dollars of capital that's out there. There's a bunch of data that's out there to what Nadim's talking about, right? So sponsors are doing screens for companies that they potentially want to go after from a platform perspective, and consequently, what are the add-ons for that particular portfolio company or potential portfolio company? That is what happens in that limited process, if you will, David, where, again, it's just an educated marketplace at the end of the day versus a broad auction process. If you don't come prepared, someone else will be there, and they'll be willing to pay a more likely than not a higher multiple relative to someone who's not as prepared.
And Isaiah, you mentioned that conference. How often do you have it? Where do you hold it?
Every year in Boston in August. So this year was the 42nd year. And we started this private company sponsors endeavor in 2017. And it was 56 private companies in 2017. The vast majority of them were founder owned. This year, as I mentioned, it was about 150 private companies, but 65% of them had some form of institutional capital behind them. And what you see is sponsors attend the conference, right? So they have ideas, or they have companies that they meet with and they can continue to track. But conversely, they will bring a portfolio company with them because they see the advantage that they get by attending the conference, being the sponsor. So again, it goes back to that whole theme of building a reciprocal relationship with the sponsors community, with the Michelles of the world.
Okay, very cool. And Michael will give you the final word on our program. Best advice in some of the narrower auctions that we're seeing.
Yeah, I agree with Isaiah. Said differently, when we have a client that we're taking to market in a narrow auction, we're looking for sponsors who have domain expertise, right, who understand that industry. And so it's very similar to what Isaiah was saying, right? The sponsor that really understands the industry and understands the company is more likely to pay a higher price. So I think that the days of the generalist private equity funds are dwindling, quite honestly.
Okay, on that note, the disappearance of the generalist firms, we'll call it a program. We are out of time, and I'd like to thank everyone for coming. Really appreciate you taking time from your day and also asking some great questions, which makes my job as moderator much easier. I'd like to thank our sponsor, SPS by Bain & Company, for hosting the webinar, making it all possible. I'd like to finally thank our speakers for doing a great job. Nadim Malik of Sutton Place Strategies, Michael Butler of Cascadia Capital, Michelle Eidson of Crest Rock Partners, and Isaiah Knopf of Concord Genuity. Goodbye, everyone. Enjoy the rest of your day. Look for the recording to come in about a couple hours. Take care.
Thank you, David. Thanks, everybody.
Thanks, David. Thanks, everybody.